Hello and a warm welcome to Econoday Unplugged on Tuesday, the 8th of February 2022. Terry Sheehan is stateside and I'm Jeremy Hawkins in London. By and large, recent economic data have been strong enough to leave a number of central banks trailing well behind investors' expectations for interest rate hikes. It may be that financial markets are getting ahead of themselves. If nothing else, Omicron is going to make a mess of many first quarter GDP reports. But as inflation continues to surprise on the upside, there's a rising risk that monetary tightening will be delivered too slowly. If so, then rates are likely to peak at higher levels than if a more aggressive approach were to be adopted now. And that, of course, could mean a bigger hit to economic growth further down the road. So, Terry, you've just had what I suppose we might call a stonking January employment report. Was it really as big as it looked like?
Yes.
Good. Right. Moving on.
No, really. Now, part of it was that the January report includes revisions to the payroll numbers that are released annually. So some of the stonking size of it was from that. But it was still a very strong report, showed strong growth in average hourly earnings. It showed that people were coming back into the labor force. So most of the major numbers were moving in the right direction, which is really good news for the Fed and their assessment that we are reaching maximum employment.
Is the employment level actually back to before the pandemic level yet?
It's definitely closing in on it. But the problem, of course, is that the labor market has seen some restructuring. Mm-hmm. So the two aren't exactly equivalent, but what we are seeing in the weekly unemployment claims data is that businesses are not laying off workers. They're holding off to the ones they've got, and people who have been unemployed are finding jobs. Now, it was also in the employment situation report for January that a lot of those jobs were coming back in leisure and hospitality fields. So we're getting there.
All right. So if the employment side is doing pretty well, you mentioned earnings. If I remember right, the best part was it a 15-year high now? So I mean, yes. Just how important is that going to be to what the Fed does in March and indeed beyond that?
Well, it won't be necessarily immediately important to what they do in March, but it does raise red flags in terms of looking for wage inflation creeping into overall inflation. This morning we had a report from the NFIB on small businesses, and one of their major concerns is the fact that what they're having to pay for employees is the highest it's ever been. So this is something that the Fed will have to keep an eye on, especially if the supply side constraints that they've been saying are one of the major factors contributing to inflation start to subside as expected. So the inflation outlook is by no means certain yet.
All right, well, because you mentioned the magic word, and of course, I guess the key release, at least as far as this week's concerned anyway, when we get the inflation update on Thursday. So what's it going to look like, do you think?
Well, I think it'll be a little less bad than we saw in the prior report, but because some energy prices were coming down in December, but it's still going to be at worrisome levels.
What about the core rate, do you think? Is that going to accelerate, or is that going to come off a little bit as well?
I think it may come off a little bit, but these movements of up or down a tenth or two shouldn't be read too closely. The underlying pace is still for more persistent inflation than we've seen for many a year here.
All right, and presumably, the longer these rates stay above the Fed's target, then just quite simply whether they're going up or not, I mean, it's going to be increased pressure on your FOMC to do something with interest rates.
Yeah, I mean, we're not looking for the rate hike until mid-March, but what they decide to do, I mean, if the numbers are sufficiently bad, we could start thinking about a 50 basis point increase in March rather than the 25 that's expected now.
Okay, fair enough. One last thing as well. Back into this week, we'll get an update on consumer sentiment from the University of Michigan. That's been, at pretty low levels for a while now, hasn't it? I mean, do you think that's going to tell us anything about what might be happening or going to happen to consumer spending?
Well, I think it reflects sentiment, not actual behavior. Because what we've been seeing is consumer spending's actually been holding on pretty well in spite of the fact that sentiment is low. I think it's more that sentiment has been worn down by the length of the pandemic, and it's hard to feel encouraged by developments when we keep getting wave after wave of variants here. But people are beginning to return to more normal lives. So I would keep an eye on sentiment, but I wouldn't read too much into it at this stage because these are, in the historical context, unusual times.
To say the very least. Yeah. Okay, great. Anything else from your side, Terry?
No, I think right now we are just waiting on the CPI later this week.
Okay, fair enough. Thanks for that, Terry. Right. What do we got for Europe then? Well, I guess while investors' central bank focus has been very much on the Fed so far this year, it's the European Central Bank that really shook up financial markets last week, triggering both a substantial increase in bond yields as well as a firmer euro. Now, the ECB isn't exactly known for moving quickly, but last Thursday's meeting really suggested a change of policy is much closer than a central bank would have had you believe as recently as last month. President Christine Lagarde's press conference really was surprisingly hawkish. Clearly signaling that the central bank has become much more worried about inflation. She wouldn't reiterate her previous contention that a rate hike in 2022 was very unlikely, and conceded that inflation is likely to be higher and stay so for longer than anticipated at the start of the year. Significantly too, and in fact for the first time I can remember anyway, she even offered an inflation risk assessment, which of course was duly tilted up. And it's just left financial markets pricing in around a 50 basis point or so tightening by the end of this year. So markets now certainly expecting rates to be going up. It does seem then that a policy recalibration, to use ECB's favourite term, in March is very much odds on. However, before interest rates are going to go up, if indeed they are, quantitative easing needs to end first. Now, the PEP, the emergency purchase program brought about by the pandemic, that's due to expire in March, so that's not really an issue. But the asset purchase program, which is the other part of the central bank's quantitative easing arm, the long-standing APP, that's open-ended. So it may be that perhaps as soon as March, we'll get the announcement of a fixed end date for the APP, perhaps for as early as the third quarter, something like that. Certainly, the Governing Council's hawks thinks that rates should be going up in 2022. And interestingly, last week, the head of a Dutch central bank, Klaas Knot, actually broke ranks and said he expects a 25 basis point increase as soon as October. So we talked previously on a podcast about the chasms appearing in the Governing Council in terms of what to do with monetary policy. Well, this is very much a further illustration of that, and it really does seem now as if the hawks are in the ascendancy. In terms of the data, well, no surprise really that the December numbers look pretty poor. December retail sales were down 3% on the month. That's their worst performance in the Eurozone since April of last year, but really just on the back of Omicron. Germany actually saw a decline of some 5.5%. But, and it's an important but in terms of what's going to happen to ECB policy, there have been signs of better things to come out of the Eurozone's largest member. Most of the media headlines last week focused on a surprise fall in the December industrial production out of Germany, is down 0.3%. But that in many ways missed the point. It was wholly due to volatile subsectors and mainly came out of construction. More significantly, manufacturing output was up just over 1%. And it's increased now for 3 months in a row. Orders, manufacturing orders have risen the best part of 6.5% in the last couple of months. And of course, the PMI's composite output index that jumped sharply and well above 50, the expansion threshold in January. And if the German economy really is improving, and of course, a Eurozone economy is going to improve as well. And for the Eurozone as a whole, and Germany in particular, there's a pretty tight labour market there and certainly shortages of skilled workers. So in the same way as Terry is talking about from her side of the pond, it's we're talking about upside pressure here on wages. That hasn't really materialised in the actual wage data so far, but they tend to come out very late. So really, we don't have a particularly good feeling on what's going on at the moment. But if things continue to shape up as they are currently, it does seem we'll start to see wage pressures coming through on the headline inflation numbers. The other aspect which is important to mention for Europe is that Omicron at long last seems to have peaked. We saw a very sharp increase in rates pretty well across the region over the course of the last month or so. Germany and France in particular being especially worrying, but in both those countries now it appears that the numbers are coming down, actually coming down quite quickly as well at the moment, and that's going to be good news clearly for the economy in general, the rate of growth, and also potentially for the tightening of the labour market. We'll move across to my side of the channel. Bank of England is certainly looking through COVID and has also become a good deal more hawkish. As of last week, I should say, the Thursday MPC meeting for February, we saw a 25 basis point hike in a bank rate there. That was in line with expectations, but the vote was much closer than anticipated. It was 5-4. And those 4 members who dissented against 25 basis points wanted a full 50 basis point hike, which should have taken bank rate up to 0.75%. So it was only down to Governor Andrew Bailey's casting vote that bank rate now is not another 25 basis points higher than it actually is at the moment. So there's clearly been a major shift in sentiment about inflation. And indeed, the new monetary policy report that the bank issued alongside its MPC meeting last week puts its forecast peak to inflation as high as 7% in April. That's up from 6% last time, which in itself was up from 5% in the previous meeting. So it really does seem to be the case that in line with a lot of market forecasters, the bank's been significantly behind in terms of estimating where inflation is going to go. Anyway, Thursday's hike is important for the quantitative easing side of policy, as it means now that any maturing government bonds from the 875 billion quantitative easing stock and the 20 billion worth of corporate bonds will no longer be reinvested. There'll also be a gradual program outright corporate bond sales to fully unwind that stock, probably by the end of next year. In other words, now, in addition to rising interest rates, we've also got the start of some shrinkage in the bank's balance sheet. It'll unwind to start with of its own accord, and on the basis of which really you should interpret last Thursday's announcement from the bank as really constituting more than just the obvious 25 basis point hike in interest rates, because balance sheet reduction is going to add to the monetary tightening impact. What else have we got in terms of the numbers this week? Pretty well all bundled into Friday when there's a wodge of data. They will be hit by Omicron, in particular the GDP numbers. The monthly figure for December, that's expected to be down about 0.4%, having risen 0.9% in November time. But that really will be due to Omicron effects, and the bank quite clearly is prepared to look through them. More important in many ways, next week we'll be getting updates on the UK labour market and magic word inflation as well, and they're going to be particularly closely watching. It really does seem to be a case now of just how quickly interest rates are going to rise in the UK, unless it turns out we really do get some surprisingly soft wages numbers. It's difficult not to see UK interest rates, I think, hitting 1%, really before too long. Let's put it for the UK. In terms of the other bits and pieces, I should mention Canada. January employment report that also came out alongside the US last Friday. That showed a 200,100 decline. Again, though, reflecting the impact Omicron. We saw the unemployment rate going up by 0.5 percentage points to 6.5%. Hours worked were down 2.2%. So, pull it all together, it does suggest that the Canadian economy didn't start too well in the first quarter, in the beginning of the year. And indeed, the downturn in January is going to weigh upon first quarter in general. Nonetheless, a lot of these Omicron restrictions have now been lifted. So those factors which were holding growth in check back end of last year and beginning of 2022 are no longer going to be particularly significant. So still looks very much as if we're going to see the Bank of Canada raising interest rates, quite possibly at their next meeting, which will be at the beginning of March. Last, in terms of central banks, we'll get a Reserve Bank of India meeting. That's due tomorrow, Wednesday. No change expected out of that one. And that's pretty all it, I think, apart from obviously just, I suppose, can't leave the podcast without mentioning the Russia-Ukraine situation. It's difficult to see what's particularly changed since the last time we spoke on it, by the fact that more troops than ever seem to be lining up on both sides of the border. And of course, what happens there will have significant implications for financial markets and especially the European economy in general. Okie dokie, so that is it for this podcast then. I guess it's not often in recent times that the ECB has stolen the limelight, but even the hawks there are clearly in the ascendancy. So with few exceptions, higher borrowing costs look more likely than ever to be the order of the day over coming quarters. We'll be back again next week, and for coverage of all the key economic data and events, don't forget to keep your eye on Econoday's global economic calendar. On behalf of Terry and myself, thanks as always for listening, and we hope to see you soon. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com.